Welcome. I'm Elaine Pantel, a partner at Shimmerman Penn, and we're pleased to be here as a sponsor for the OAA 2021 conference. Our presentation today will be on maintaining sustainability and growing your firm, and after this recorded presentation will be available for questions and discussion. Tell you a little bit about our firm. Shimmerman Penn is a boutique CPA firm based in Toronto. We provide a full range of core services, but what makes us unique are our tailored business advisory services, which allow us to connect and build relationships with our clients to help them meet their short and long-term business and personal goals. Although our client base covers many business sectors, our firm's growth strategy is focused on certain industries where we can add real value to the owners at a high level, and the architecture, engineering, and design industry is one of these. We are longtime supporters of the design community and have been actively providing educational programs, seminars, and events, and sponsoring and supporting industry groups such as the OAA. I'm also proud to share with you that in 2010, our firm was invited to assist the OAA in drafting changes to the provisions of the Architects Act that deal with the ownership rules for firms. Our team consults with firm leadership on many topics, such as succession planning, tax planning, corporate restructuring for owners and their families, and performance benchmarking, which we will be talking about today. Over the past years, the founders and ownership groups of architecture firms are focused on ownership succession and integrating a transition plan as part of their firm's long-term growth strategy. Founders are thinking about legacy and continuity of earnings, and associates and senior professional staff are thinking about making a commitment at a fair price, given their contribution to their firms during their years of employment. We take a holistic view to defining success and building value in architecture firms. These are the components that contribute to building value, and we've presented on these topics at OAA conferences and presentations over the years. For today, we're going to be focusing on value and benchmarking. So let's get started. For today, we're going to look at the learning objectives that we're trying to accomplish. A key factor for sustainable growth is healthy profits. There is a direct link between the firm's financial performance and value, which is important for internal employee succession strategies and also the long-term planning for the owners. Financial strength is achieved by coordinating efforts throughout the firm. On a macro level, or large picture, the focus is on integrating strategic planning and developing the firm's culture. At a micro level, internally in the firm, the focus is on budgeting and monitoring of projects and managing firm overheads. Benchmarking your firm's financial and operating performance provides valuable strategic information to help answer some important questions. Where do you excel and where do you fall short compared to your competitors? Are your strategic initiatives delivering expected results over time? How is your most valuable resource, your professional staff team, being used? Are you carrying too much overhead? So today we will highlight how management can use key financial metrics to monitor and assess the financial health of their firms, manage day-to-day operations, and set performance targets. So we'll use this graphic throughout. So overall here, we're focusing on sustainability and growth. I'll start with presenting how a financial highlights dashboard can help leadership and project management achieve their goals. We'll then look at financial metrics and benchmarking and how to understand key financial metrics that focus on architecture and design firms and help you build a financial highlights dashboard. We'll close with some comments on technology and present some industry resources that you can use. So owners are the main decision makers in the firm, and they should have access to quality information on a timely basis about the firm overall. We also recommend creating dashboards for project managers, as they can benefit from timely information to help them make decisions and manage their projects on a daily basis. The key is to ensure the right people have access to the right information. Look at metrics on a frequent basis and make it part of the regular review process. Comparing your firm's performance over time will help you identify areas in which changes are occurring and will assist in strategic planning, risk management, and operational decision-making. Comparing your firm's results to industry trends will also help in strategic planning and to help identify areas where changes could be made to improve profitability and efficiencies, again, contributing and increasing the firm's overall value. There are many different metrics that you can use to track, to assess your business, and there are numerous resources available that provide industry data. I will come back to these later on. The key here is to choose metrics that are the most meaningful and for your firm. So some tips in creating a financial highlights dashboard. Firstly, create one that you can maintain. Creating a dashboard can either be through Excel or through your project management software, for example. So the key here is to create a tool that will be easy to use and maintain and update as the business grows and changes. You want a clean and predictable dashboard. We start with pure data when we're presenting dashboards to clients, focusing on the quality of the data, and then build in graphics. I know as a group, architects are very creative and enjoy data presented in graphical ways. So I will show you some examples of what that could look like. Choosing the most essential metrics. This is quality over quantity. It's very important that these support your objectives and serve as a main pointer of progress towards that objective. And obviously, keeping it up to date and accurate. It'll be important to decide on the frequency that you will be looking at these dashboards and updating them. And this will depend somewhat on the way your business works and the accessibility of information. And over time, you'll be able to see the trends. Here are some examples of dashboards. I've pulled some screenshots to show you. It's really up to you how creative you want to be. This one is quite graphical. This next one, which I like, actually presents the base data, and I'll be showing you a balance sheet today, and then the representation of some of the metrics here in a graphical sense. This slide is from Dell, and it's a screenshot of an executive dashboard, also very graphical here, and another one here, which is a project manager's dashboard, which is very different. It's showing project management over time. So there's a lot of creativity that can happen here. So then the next section, we're going to spend a fair bit of time now on key financial metrics and benchmarking, and actually look at a particular dashboard. We will focus on the types of metrics that are common in the architecture industry and that will help leaders and their teams better understand their business and also provide insights on industry performance. So we'll be looking at three types of metrics: performance metrics for current and past years, efficiency metrics, which relate to project management and professional labor, and then predictive metrics, which focus on the future. We'll start with the firm's financial statements. This is a useful place to start because it helps build a connection between the financial information and decision making, starting with financial reporting that you're already looking at. This also helps you better understand how to read financial statements and to look at these results in a much more dynamic way. Operating metrics, as they relate to the balance sheet and then the income statement, will allow users to focus on the two key areas that are separate yet linked. Understanding how to analyze profits and also determine whether the firm's cash flow is at a healthy level. Both are tied to sustainability and building value. So to help us, we've prepared a sample set of financial statements, which are a balance sheet and an income statement, and we will refer to these when we look at our actual dashboard. Starting with the balance sheet, it's a statement of financial position of the firm at a point in time. The annual financial statements are at the fiscal year end. So if you're tracking metrics during the year, say quarterly, you'll need to be generating internal financial statements at the period end date. For illustration here, we're using annual statements. The most significant assets in an architectural firm are work in progress and accounts receivable. If the firm carries sub-consultants, there could be significant payables to the subs as well as a liability. The key to maintaining successful cash flows is an efficient billings and collection system and will allow the firm to pay its sub-consultants on a timely basis and also meet its payroll and overhead costs. If your firm uses a percentage of completion basis for accounting for projects, a proper cutoff at a balance sheet date includes recording work in progress and, if applicable, deferred revenue. I'll come back to that shortly. Here we have assets, $1.5 million, liabilities plus shareholders' equity, $1.5 million. That's the basic formula of a balance sheet. Next is a statement of operations, or the income statement. The income statement shows the results of the firm's operations for the period between the two balance sheet dates. Annual financial statements present results for the full fiscal year, which is what we have here. The most significant cost in an architectural firm is labor. So a lot of our analysis will be reflecting how labor ties to fees. It's very important to distinguish between gross fees and net fees, especially if the firm is carrying significant subconsultants. So all our performance and efficiency metrics for the income statement will be based in relation to net fees. So it's very important when you're looking at labor to distinguish between what we call professional labor, or could be direct labor, and indirect labor. From experience, we see that our clients and many firms have different ways of looking at these two categories. What's important is that you need to know if you're looking at external industry data, how that data is compiled, or alternatively, if you're focused on internal trends, that you calculate your components consistently over time. So I'll explain to you how we've done it for this presentation and how we look at this generally when comparing firm to firm. So we start with professional labor. Generally, for analysis, we take professional labor, which will be the salaries of all professional team members, excludes employee benefits. What we would then call indirect labor would be employee benefits for the entire firm plus non-professional staff, or we might call that admin staff salaries. So that is the basis we're going to present. That's the basis we compare and do high-level analysis year over year for our clients. And this may differ from some of the benchmarks out there. You can start with this, and then you can create sub-metrics where you're digging deeper, and I will be talking about that shortly. And there is some concept also about how to deal with owner remuneration, and I have some details on that as well. So we're going to start with the balance sheet. And the key element of a sustainable firm, and sustainable assuming the firm is generating good profits, is a healthy billing cycle. How much of labor is tied up in accounts receivable and work in progress? This would basically constitute labor costs at the billing rate that have not yet been realized in cash. There's a perennial question that clients have asked us over the years, and it's not just in this industry, but I'm going to present it in the focus for this industry, is that we're generating a healthy profit, but our cash position is challenged. And this is a conversation we've had numerous times in the past year with all the challenges of the COVID pandemic. So we're going to present three metrics that tie to the billing cycle, are reflected in the balance sheet: the aging of accounts receivable, the aging of work in progress, and then the combined of the two. We'll then present two other metrics that relate to the overall strength of the firm's financial position in its balance sheet. These are commonly looked at by banks: the current ratio, or the firm's working capital, and the debt to equity ratio, which is a measure of financial risk and leverage in the firm, also sometimes called debt to tangible net worth. Let's start with the metrics that relate to receivables and work in progress. The first relates to aging of accounts receivable. An accounts receivable aging report will help you identify customers that are falling behind on their payments, which may be a sign of an underlying problem. It's essential for owners to evaluate the effectiveness of the credit and collection functions and to determine the firm's financing needs. Generally, the longer an account balance is overdue, the more likely it'll be uncollectible and will lead to a doubtful account or a renegotiation of fees. Firm leadership must monitor the aging schedule of receivables and assist in collection activities. In the past year, we've seen this happening more and more as there were challenges to the cash flows of firms during the lockdowns. And it's now a new behavior that is continuing, which is making a difference beyond a doubt. Project managers are more commonly involved in determining percentage of completion of projects to support the billing cycle itself. So when accounts receivable are written off, it's important to give direction to your accounting department whether it will be a fee adjustment or a true bad debt. And as you will see, this will impact income statement performance metrics. Some clients have been asking whether we're seeing an improvement to the collection of receivables due to the prompt payment regime in the Construction Act. I don't have clear information about this at this point. We're getting mixed comments from clients, and I think time will tell how effective this may be. The next performance metric relates to the aging of work in progress. Work in progress is one step further from turning labor costs into cash. You must bill and collect. Generally, work in progress is only set up for accounts that are billable and collectible and at standard billing rates. Any recoverable costs are added in at cost. Commonly, work in progress in the balance sheet is the prior month's labor to be billed if monthly invoices are dated when they're issued. So for example, for the time spent in December, the bills are issued in January, and if the firm's process is to date the invoices when they're issued, i.e. January, they would be showing work in progress in their December balance sheet. Some firms have a practice of backdating the invoice to the end of the prior month. And so as long as there's consistency, you have to have an understanding, and in which case there could still be some work in progress for some additional billings that have been negotiated but have not yet been issued. Some firms only book work in progress at the fiscal year end because it's required for accounting and tax purposes. It can be time consuming if the percentage of completion will need to be calculated to determine work in progress and amounts to set up. Larger and larger firms are calculating proper cutoffs on a monthly basis because it's very important for decision making, as you'll see when we look at the dashboard. It's also helping firms pay closer attention to the timing for issuing invoices for requests for additional fees. I have to mention a caveat here that as you're listening to this, if you're thinking that you might make changes to the timing and the process for recording work in progress, issuing invoices, and so on, you must please contact your external accountants to discuss this before making any changes. There could be tax issues, an impact from making the change, and so it has to be properly thought out and before any changes have been made. The next metric will be a combination of the aging of accounts receivable and work in progress, a high-level indicator of labor costs not yet converted into cash. There's a direct impact on cash flows, financing needs, access to financing through banks, for example. And it may be common that the bank will set up a covenant in the credit facilities agreement tied to the aging of accounts receivable and work in progress. And obviously a direct impact on the profit distributions to owners. There will be an impact on employee succession plans if the new owners are expecting to receive distributions of profits and cash is tied up in WIP and receivables. And this may also be more easily compared to industry data. I mentioned I would discuss two metrics that tie to the balance sheet numbers. And the first is what's called the current ratio, which is current assets divided by current liabilities. Commonly used by banks, the current ratio is a measure of short-term liquidity of the firm. Current means assets that are collectible within 1 year, which are usually cash in the bank, accounts receivable, work in progress. And liabilities are those that are payable within a year, which are generally your trade payables, amounts due to subconsultants, HST, income taxes, and so on. So this is also known as working capital. So short-term turnover of cash in the bank. How well can the firm meet its current obligations, such as payroll and so on, as they come due? The second balance sheet metric is the debt to equity ratio, or debt to tangible net worth ratio, which is the total liabilities of the firm to shareholders' equity. This shows how much of a company's value, as expressed in the financial statements, is owed to creditors as compared to shareholders. It's a measure of the firm's capacity to meet its obligations and service its debt. This is a concept of leverage. It's very important to banks, and they assess this in their risk assessment overall for the firm because they are a creditor. They don't want to be taking on an inordinate level of risk as they define it and feel that the firm should be properly capitalized. So the bank may limit owner distributions to ensure a reasonable debt to equity ratio. So the level of equity is tied to the level of accounts receivable and work in progress, effectively undistributed net profits that could not be distributed because the invoices had not yet been collected. So here, let's go back to our balance sheet and then reflect. I'm going to present the ratio of the aging of accounts receivable, the aging of work in progress, and then both. And then I'm going to look at the current ratio, which is current assets to current liabilities, and then the liabilities to equity. And here's our first dashboard. So we show the aging of accounts receivable is 87 days in 2020 and 104 days in the year before. And the aging of accounts receivable is 32 days versus 36 days. The total is about 120 days to 140. 120 days is 4 months. So 2020, on average, we had 3 months of billings tied up in accounts receivable and 1 month in work in progress. That's 4 months. It was even higher the year before. What am I seeing in the industry? Because we're tracking this now for clients. In architecture firms, I'm seeing many firms in the 120 day range now, which is 4 months, and that's excluding work in progress. When I see work in progress greater than 1 month, then there would be an issue here as to why is it so high? Were there requests for additional fees that really ought to have been billed more frequently, and so on. So you want to be watching this very closely. A firm at 90 days actually is quite good, I'm seeing in the industry. It's rare to go below 90 days. So this is a reasonably good metric here. The current ratio, $2.43 of assets per dollar of liability is excellent. When you're getting close to a dollar for dollar, then you know you're going to have trouble. And this is a challenge. Firms that have a lot of subconsultants will generally show a lower current ratio. And this debt to equity is also excellent. It's below $1 to 1. The covenant that I'm seeing in many credit facility agreements these days is more like $1.20 of debt per dollar of equity, subject to very specific definitions of how those are calculated. So this firm is in a healthy financial position. Now we're in the income statement. So I'm going to present 3 key metrics for architecture firms to be tracking. And these are the net fee multiplier, the overhead rate, and profit on net fees. The net fee multiplier measures a firm's ability to convert professional labor charged to projects into revenue dollars. This metric provides a sense of how the firm has performed during the year, as it has a direct relationship to profitability. It's an indication of the efficiency of managing professional labor. As I mentioned, we're using net fees, not gross fees, to calculate the net fee multiplier. And for our presentation purpose, we're using total professional labor, which is the salaries of all the professional team. We're not taking just percentage charged to projects, although in some industry data, that's usually what's done. And I'll come to this later when we talk about what we call the utilization rate. There are other considerations. Some firms include the labor burden or employee benefits in professional labor. For our presentation purposes, we do not. Some firms include bonuses and overtime in professional labor. Then there's also the tracking of pursuit time. Some firms will calculate the net fee multiplier with or without pursuit time in the professional labor number. And then there's owner remuneration. I had mentioned before that I would talk about this. For corporations, owners usually take a salary, and you may make an adjustment to adjust the salaries to market level for an owner manager in an architecture firm. And if you're structured as a partnership, partners generally do not take salaries in a partnership structure, so you would want to include a notional amount for partner salaries in the professional labor for comparisons over time. So why would you want to use the net fee multiplier? As we know, labor is the largest cost in an architectural firm, And the more dollars that can be generated per dollar of labor is a key indicator of the strength of the firm. On a project basis, you can also calculate this metric, and this will help you monitor the strengths and performance of your firm by sector, by partner, by project manager, or however you want to slice it. And it's also very useful as a budgeting tool at the proposal stage. Ideally, the markup on labor is meant to take into account the overheads at a reasonable profit for the firm. If the marketplace allows that you want to budget for a higher than the expected net fee multiplier you will achieve, because inevitably there'll be inefficiencies. The next metric we're going to talk about is the overhead rate. The overhead rate measures a firm's ratio of overhead, which we would call indirect costs, which are the labor burden plus administrative labor versus the direct labor costs. This metric provides an indication of how efficiently the firm's cost structure is set up. It can be used to allocate indirect labor costs to a project, and the overhead rate also indicates how much of your overhead you incur per dollar of professional labor costs. So overhead includes costs that are considered fixed costs, which do not vary with project activities, such as your occupancy, which is rent, your professional insurance, it has some variability, administrative salaries, and other operating costs. And there's some variable costs, which are project-related costs. Also, some firms are normalizing their overhead to remove unusual or one-time expenses, profit-sharing bonuses, which we definitely do in our calculations. And if the bad debt expense is fluctuating greatly, there may be a normalizing adjustment for general bad debt percentage. So you can build that in. The next metric we're going to talk about is profit on net fees as a percentage. So profit before income tax and owner profit sharing distributions is a very good basis for measurement because it removes the effect of income taxes and discretionary distributions to owners that vary significantly from year to year or firm to firm for comparison's sake. Other significant revenue or expense items that are not expected to recur can also be removed or normalized to provide the firm's profits that are more representative of ongoing operations. This will also help you in setting a realistic target for structure, for overhead, and understanding the sectors that you're operating in. Some firms are actually using this metric to set their bonus distribution levels for the firm's compensation strategy. Let's now look at the dashboard for these three key income statement metrics. We're going to calculate the net fee multiplier, which is professional labor to net fees. Then the overhead rate, which is indirect labor plus operating expenses divided by professional labor. And then finally, pre-tax earnings to net fees. So I'm happy to share with you some comments on this. For the net fee multiplier, there is actually a general rule of thumb that if the firm can generate, and again, this is overall for the whole year, a net fee multiplier of 2 times or greater, and their overheads are reasonably maintained, then they would be generating a very healthy level of profit. So we can see here that in 2019, the firm had a net fee multiplier of 1.75, with overheads being otherwise equal, their profit was 6%. And at a 2 times multiplier, profit on net fees of 18%, which is quite a good outcome, certainly. And so, again, this is based on how we calculate professional labor for being total professional labor salaries. So also this indicator for the overhead rate, which is overhead as a percentage of professional fees, and the 64% is quite common of what we've seen, somewhere between mid-60s to 70%, generally steady over the last number of years. So, you know, it's this key here between the net fee multiplier and the profit on net fees is significant. So again, how do you use this in your operations or in your strategic planning? So you've generated 2 times overall for the year. When you're budgeting, are you using 2.5 or 3 times multiplier to budget? And then are you using this profit percentage to help you with compensation? So I'm going to take that profit percentage and now present it in a different way so you can see the use of the numbers. So I'm taking the three key components that comprise net fees and presenting them as a percentage. Professional labor at 50% versus 57%. Overheads, this is the inverse of the net fee multiplier. Overheads at 32%, the profit at 18%. So I'd like to comment on this track here, which is professional labor as a percentage of net fees, tracking this for a number of clients. And I would say maybe a number of years ago, you could see firms below 50%, but this is no longer the case. And in fact, now what I'm seeing strategically is that firms, now that they have this history, are actively saying, okay, we're going to move up to 55% this year because we want to attract and retain excellent people. We are moving people up the career ladder into higher level positions to get ready for its succession strategy and improve the team. And we know we live in a market where salaries are going up and costs are up. So it's purposeful, and then the question is, okay, if we do that, what will happen to our profits? And it's then a strategic decision to move that. And so the question may be that you could still achieve excellent profits depending on how you're running the firm and what you're achieving in your project outcomes. So it's actively used in strategic planning. So there are other income statement metrics that I'm going to talk about, because what I presented is an excellent first start of a dashboard, but an area to dig deeper would be to go back to the labor costs and understand more deeply what's going on. So there's a utilization rate, and firms are now starting to track this actively. So we'll talk about that. Net revenue per employee, that's a metric that's out there, that's more easily comparable in the industry. And then looking at the overhead costs, if you're concerned that your overheads overall are trending high compared to the industry, what should you be looking at? So if you beyond labor, you look at the most important costs, the highest costs, which are occupancy costs, increasingly now technology costs, pursuit costs, bad debts, could be admin staff, and so on. So whatever is meaningful to you as a decision maker will determine what additional sub-metrics you want to calculate. So let's talk about the utilization rate. It's the ratio of the time worked on projects to total hours worked of the professional staff. It's a percentage. So for our first set of metrics, we use total professional salaries. The utilization rate takes that total and breaks it into the percentage charged on projects. It's important that it's not a measure of billable time versus non-billable time, because not all time charged to projects is billable. So maintaining a utilization rate in an optimal range can enhance your overall profitability. It is a measure of your firm's effectiveness and efficiency in project management. If the rate overall on an average is within a reasonable range, it's a good indicator that you're using your firm's primary resource well. I don't have a lot of industry data here or comparisons within our clients, because it's a metric that I have not seen captured on an active basis. We're asking our clients if they have this ability in their systems to extract this information, to start to track it and show it to us. And what would happen, you would expect, you could see outliers within your team. At the most junior levels, the utilization rate will be higher. As you progress up through the staff team towards leadership, management, and so on, the utilization rate is expected to drop as these individuals are spending time on other activities rather than direct project time. So you can then calculate a submetric of the net fee multiplier by applying the utilization rate to your professional staff dollars and then recalculating the metric. That is actually more comparable to external resources as well. Another metric I mentioned is net revenue per employee. It's a measure of past or actual performance. It's a useful gauge to check whether net operating revenue you're projecting for the coming year is realistic compared to the past. So it's hard to say what the target is. It varies. Obviously, all the factors that lead to net revenue is it's not net fees, it's net revenue, so it's on a profit basis. So this is something to be tracking over time and to see as a sort of a feedback loop if your strategic plans are materializing. Finally, I'm going to spend some time on predictive metrics and the power of these. We'll start with the contract backlog, which is sometimes called a revenue backlog. It's a value of revenue yet to be billed or earned. It includes projects that have started and not yet started, but what's important here is that projects that are won, that are in the bag basically and are expected to be completed. Changes in the company's backlog can have many implications. A rising backlog may indicate that a company is experiencing increased project revenues or production problems. Certainly we saw in the last year that many projects were deferred, put on hold, slowed down. So we would have seen a rising backlog for that reason, not necessarily meaning the firm is winning a lot of new business. A falling backlog may indicate the company's billings or wins are falling, or could be an increase in production efficiency. So looking at the backlog is valuable information and will help in predicting your labor needs over time. But in isolation, it could have limited meaning. So you would want to build this into your dashboard and look at it in context of all the other metrics that you're tracking to see how the changes internally are impacting what you see coming down the pipes in the future. The hit ratio as a proposal win rate could be important in your marketing, but I want to spend time on the next one now, proposals pending, and I'll explain to you what I like about this one and how clients are using it. So prospects would be those proposals which you believe the firm has at least a 50% chance of winning, and suspects below 50%. So what some firms are doing in the contract backlog, they're projecting future billings will create a second line of the expected potential future billings of the prospect proposals out there. And it gives a more in-depth analysis of the future staffing needs and your history of winning projects and so on, and how you're strategically planning your business development will give you more sophistication with this over time. And as the firms get larger, it's really important to be focusing on this as a predictive metric. So in the final section here, I'm going to talk a little bit about technology and then leave you with some resources for good sources for benchmarking data out there in the industry. So as we know, especially from our experience in the last 12 months, the use of technology in running our firms, in our industry as well, is essential. And in the architectural field, I am certainly aware that tracking technology costs is now a major overhead cost in firms. So we want to talk about how you can use financial benchmarking in light of technology options for you. So we're coming back to financial management and how tech can help. Information flow there is what this is all about. So once you've set up your dashboard, and the key is to be able to extract good quality data from your system on a regular basis is going to be what's important. So if, for example, we talked about the fact that you may not be doing proper cutoff of WIP and so on a regular basis, are there some metrics you could track periodically, or are we going to look at more of an annual tracking? I think what I'm finding and working with clients over time is there's a move to try to get better quality data, maybe even twice a year or quarterly. But again, as I said, speaking to your accountants to figure out what would be necessary to make a change. But once you have the data, and how you share it with the user group is going to be really important. So centralizing information in the cloud is great. To have more efficient decision making, you want to have access. Project management and project manager dashboards is becoming more highly used. So how does your project management software help? Can you develop these dashboards? And at the leadership level, can you share all this information actively? So all the leadership team, wherever they may be, centralized or decentralized, depending on the size of your firm, will have access to the information. If you have built-in graphics, this is obviously going to help, and it's a very easy way to communicate information. So this is an important consideration. Finally, here are some industry resources that are helpful. And I think you always have to be careful of what market you're looking at and read the fine print as to how these metrics are being calculated. But again, as I said, if you're not sure about that, you could certainly track the trends over time and compare them to your own internal trends. So this completes the recorded part of our presentation for today. And thank you very much. And we will now be available for Q&A.
Thank you for participating. We're not clear how many of you are out there listening, but we do have some questions that are coming in. And I thought before I answer the questions, I'll just briefly introduce myself and my partner, Milo Spederetti. We're both very active in the firm's group for architecture and engineering and design firms. So we set out today to present 3 major learning objectives to provide tools to help you maintain a healthy financial position and create value, to see the link about these different elements of how the firm operates to its value, and to help you set up a dashboard, learn about some of the key performance indicators that are very prevalent in our industry, and set performance targets, how to integrate real-time information into long-term strategic planning. So thanks for those of you who have already submitted questions. Thank you very much. And I'm going to start to go through them, and we do appreciate all of your questions. And once we reach our time limit, if there still are questions, of course, we'll be available on our booth as a sponsor for the conference. So let's get started. First question, do you consider QuickBooks the complete software for bookkeeping? So it's a good question. QuickBooks is a very well-known software application out there. It's good for business bookkeeping. However, we're finding in the architecture industry, what you're missing with a general software package like QuickBooks is the project management. So deciding to move to a different platform, which is going to be a lot more expensive, but will give you the capability to build these dashboards and extract this really important information from your system, is really the question: when do you make that decision? As a small firm or a startup firm, it's a big investment. So I think that would be something to think about. Another question here: what if certain employees are constantly placed on jobs that are in the red? That's also a good question, because what this information will help the leaders of the firm think about is the reason that they take on certain type of work. Sometimes the leaders may decide to take on certain projects which they know may not generate a lot of profit, but there could be a good reason strategically behind that. There could also be performance issues about why, how the firm is running its professional staff. Are there issues with efficiency? Were the budgets properly communicated in terms of hours that are needed to be spent on the project, and so on? Why are there losses on the project? There are many, many different factors that will communicate that, or that will contribute to that. We tie that back to metrics. The thing is that we're talking here, the dashboard I showed you was a high level end of year, big picture macro dashboard. I did start off talking about internal detailed project-based metrics versus general firm big picture metrics. So you can apply the same kind of metrics to the projects themselves. You can allocate, you can determine these metrics by industry sector in terms of the firm's clients, the types of projects, and so on. So you can gather this information. It's really important how that's communicated to the people who are involved in these projects and why those performance metrics are generating that kind of a loss. Next question is, what would be an average size firm, number of employees, to make these financial metrics a good value for the firm? You know, I think a year ago, or actually more than a year ago, before COVID, I might have answered differently than I am now, because over this past year, I've been talking to a lot of smaller firms about starting and helping them build these dashboards, because they feel, the leaders feel they need absolutely a better understanding of how all the pieces fit together. A lot of important decisions about payroll and who's on the team, where to hire, and how to manage these costs, how to track performance better. So smaller firms, I can't really say, I actually look at it more by the amount of billings that the firms are generating, but I'm seeing firms generating billings in the range of even $2 million, up to the largest firms that we would see in the $30 million range. So it's such a broad range, but we're seeing certainly at the smaller level more firms starting to at least do the basic metrics, those first few, like 5 or 6 that I set up in the dashboard, and start to track them over time.
Yeah, I think, Elaine, maybe just to add
Sure,
to that is,
sure.
I think it's valuable for any size firm, because one thing I want to say about creating the dashboard, and a lot of people might ask, then about starting to benchmark it and compare it to other firms. But I think what's really important and valuable is starting to understand your own firm. And so any size of firm can benefit by starting to analyze their history and look at it and use these metrics to help them make decisions for going forward. So I really think, yeah, it's any firm. You might only start with a few of them, but I think anyone can benefit.
That's great. Yeah, I agree. And so we are seeing that happening. Another question here is, how can an architecture firm's accounting team use Dell Tech software to track the success of each project? So this is great, because a couple screenshots that I did pull off online for this presentation were Dell Tech screenshots. And this is going back to the very first question about QuickBooks versus something like Dell Tech or Clearview, or some of the other industry leading software packages out there, is that they do allow for incredible data analysis that we're finding actually in the discussions with firms that are making the investment or have made the investment in these software packages, that they're not really using them to the best optimization. Like, they've been using them for project management. They haven't really started extracting a lot of analysis on the projects. So I'm seeing that there's a trend here also for firms to make sure that they're making the investment in this product, to use it in the best way possible, to try to start to understand how to do this better. So another interesting question here is about, for firms that are transitioning new owners into the business, how does this kind of area of knowledge help? Or are we seeing that firms are trying to help new leaders and new partners coming in to understand this kind of information? And that's a great question, because we do a lot of work in succession planning. We've talked about that. We're working with firms of all sizes who are trying to develop organic succession strategies. And part of what happens in a lot of these projects is that we're talking to the people who are being offered ownership. And part of the education process is to help them understand how the valuation of the firm was arrived at by the owners of the firm. And then how do some of these analysis and long-term metrics of the firm's performance tie into how that was achieved? And how will that impact their roles in the future when they take on an ownership role? So it has so many different applications aside from day-to-day management. It's long-term, and it is part of succession.
Yeah, I can add too. Personally, I've recently done 2 consultations with employees that were provided offers to buy into their firm. And in both cases, these firms did have a dashboard available. And so I found it really helpful looking at it together with them to help evaluate, the health of the firm. And we were looking at the valuations that were coming up. So I think it does add value in lots of ways besides that day-to-day management.
Great. So another question, in looking at total annual working hours for specific positions, principal, project lead, technologist, etc., and billable versus non-billable targets as a percentage of total annual working hours, are there useful industry resources or benchmark standards? This is the utilization rate that I mentioned towards the end. It was presented more as a sub-metric because it means you have to have really excellent data. So the very last slide, we presented a couple of resources in the industry. I mentioned Dell Tech does reporting, PSMJ in the United States with a major, be careful because you're looking at US data. And there's also, there was another one. We'll have to check that. We can connect with you directly and point you in that direction. I think the major thing to be a little careful about when you're looking at these other reports is to read the details of how they're coming up with those particular metrics, because it can make a huge difference. So someone asked a question about when considering BIM implementation to a design firm, how does this approach affect financial workflow? I'm not sure what's meant by financial workflow. I think project management and the impact financially of how the projects are managed by implementing additional systems enhancements is what you're looking at here. So I'm not exactly sure what your question is, and perhaps you could reach out to us directly and we can talk about that a little bit more. Do we have another question? Do we have a matrix where labor is not the cost of production, but is the cause of production? In another way, it is not counted on the liability column, but in the asset column. That's interesting. It clearly is an asset in my view, because your people are your most important resource in the firm. So labor, when you look at a balance sheet, we do show accounts receivable, which is really the labor at billing rates that has actually been invoiced. And then I mentioned and I showed you work in progress. The work in progress is also labor costs at standard billing rates that have not yet been invoiced. So the work has been performed. It is going to be, it is determined by management that is billable and collectible. So it is reflected as an asset. So to the extent that the work performed, which is represented by the salaries and employee benefits of the team members, to the extent that it has not yet been converted into cash, it will show on the balance sheet as an asset. So I hope that answers that question.
Can I add something there? Is because
Sure.
that asset is really deriving the revenue that has been earned at that point. I hope I'm not talking to accounting terms, but your labor cost is going to be on your income statement as an expense. But what ends up on your balance sheet is, you know, how it is a connection to that labor, but it's deriving how much revenue you've earned at that point in time for that labor. So I think that's that cause that you're talking about. And so there's two different metrics, as Elaine went through in the presentation, is first looking at what's on the balance sheet, and the labor and the WIP is really about getting it billed. And on the income statement, it's that relationship of your revenue to the cost of the labor. So I don't know if that helps identify what you were asking for.
Thank you. Here's a question. Thank you for asking. For those architects interested in incorporating their own firms, how does Shimmerman Penn help with this? So actually, a lot of our presentations at the OAA over almost 15 years now have been all about teaching about firm management startups as well. And we did participate in a program that the OAA offered on starting an architectural firm. So we wrote one of the course modules on business structures, incorporations, so proprietorships, partnerships, and so on, ownership agreements. So as far as I know, I'll just mention that that program is now being changed, will be offered in a different way, but this is definitely a part of what we offer in the industry. We are seeing a number of startup firms, but there's a challenge there because the costs of startup are significant. We've got talked here about software. There's professional liability insurance, which I know you're learning about, some of the conference sessions and so on. But yeah, this is an area that we can help. I think one of the most dynamic areas we're working in is in succession planning, and how Mila's mentioned also that we were sometimes working with the leadership side. We're also working with people who are being offered ownership. So there's no right or wrong way to structure these things. They're very dynamic and creative, and they're different in every single firm. The pricing models are different in every firm. That was a topic that we were going to offer actually at last year's conference. We're ready to talk about that. And maybe next year at a live conference, we can talk about trends in succession planning that we're seeing from the various transactions that we're handling in our firm. So this topic for today, we feel is a piece that underlines a lot of what we do, because it is, as I said, short-term, long-term, affects everybody in different ways. Harnessing the information and using it. I think those are the actual, I don't see other questions.
Yeah, it looks like we're coming to the end of questions. If anyone has any more questions, I guess we have a few minutes left. Please send them. Something I was thinking about, maybe just to add to the conversation, is sometimes I get asked questions, you know, again, about the benchmarking, and once you look at some metrics, people want to compare themselves, right? But you have to be a little careful, because even the type of industry you're working with as clients is going to impact your metrics, because we'll find clients who perhaps are doing condo work or retail or institutional. Those clients are going to impact what's happening in your own firm. You know, some of them are slower payers, better payers, more profitable. You might be working in a very niche area because it's an area I enjoy, but it may have certain metrics attached to it. So again, going back to a comment I said earlier about the dashboard helps you understand your own firm better. And once you understand that, you can plan for the future. You might also use it to help understand how you can diversify.
Thank you for that. And actually got me thinking is that another exercise we've undertaken with some clients is, once the dashboard's being set up and the numbers are being tracked for a period of time, we've sat down with the shareholder group to try to help them set reasonable targets. Understanding that to get 20% profit it's a nice aspiration, but is it realistic given the type of work, as to Milos' point, the type of work the firm is doing? What are the margins? What are the pricing pressures in that particular piece of the industry? So actually setting targets that do allow for stretch, but are reasonable. And then that's a feedback loop that does continue to get updated, because as more decisions are being made and new data comes into the dashboard, then the trends become clear as to how that's going and the impact that's having. There is a question here: sole proprietorship versus incorporation for startups. So the sole proprietor, just a quick snapshot of ownership structures, but the sole proprietorship is the easiest, least costly alternative for one person starting a firm. Can be converted into an incorporation at any time on a tax deferred basis. So there's a lot of flexibility there. So some pros and cons about that structure, but it is an easy startup based for a sole person. So as we approach 4:15, I would like to invite everybody to please come over to our booth. We are live. There is a chat there at the booth, and also please feel free to reach out to us directly by email. We'd be happy to talk to you, and any feedback you have would be much appreciated. We do appreciate that you're here. It's hard because we can't see you. It's different than presenting live, but thank you very much for being here.